This week, I was in a conversation with a client who is retired, and they asked the question, why does it seem like the market goes down faster than it goes up? This is a great question, one that investors across all phases of life may ponder, but quite possibly more so with those investors drawing on their nest egg versus younger individuals that may be adding to it. We're going to dive into this notion of the stock market taking the escalator up and the elevator down. Before we get to that, a couple headlines on the week. First, the US Federal Reserve met on Wednesday, and as expected, they voted to increase short-term interest rates by 0.5% to help combat inflation. The Fed went on to state that central bank officials are not actively considering a rate hike of 0.75% in the coming meetings. Now, this forward guidance was initially viewed favorably by financial markets, however dissipated later in the week. Onto the labor market. The employment report this week showed recent job gains were better than expected. However, there was no change to the unemployment rate, which sits at a low level of 3.6%. In summary, inflationary pressures remain in the economy. The labor market is very strong, which continues to put the Federal Reserve in a tough spot of reducing the rate of inflation without triggering too much of a decline in economic activity. Okay, back to our stock market escalator elevator analogy and why the market seems to go down faster than up. First, psychologically, researchers have found negative emotions like fear and sadness trigger increased activity in the brain linked to memories. These emotionally charged memories are often preserved in greater detail. Tying this to the stock market, we often have a clear recollection of a declining stock market time period, such as the great financial crisis of 2008 and 9, or the March 2020 COVID-induced stock market decline of 34% over 1 month. Second, we look at the history of the stock market. What we find is that our intuition of markets declining faster than the increase is pretty true. This chart of bull market increases in blue and bear market declines, which are declines of more than 20%, in red, does a good job explaining this. What quickly stands out is that the red decline periods have historically been steep and short-lived. In fact, bear market declines have averaged negative 38%, and they last about 15 months, again on average. These large drops over short time periods goes to show that the markets do give us the impression of taking the elevator down. Of course, the other key takeaway from the graph is that market advancements in blue, the escalator up tends to be longer lasting. To stick with our analogy, the escalator climbs more stories over longer time periods. In fact, bull market advancements on average tend to last about 70 months and return just over 200%. So what do we do with all this information? Well, the principles of diversification of investments are important in both up and down markets. Here we looked at just US stocks. However, investors should not rely on any single investment or asset class to create success. Also importantly, we plan for uncertainty. Financial markets will always go through cycles and periods of market declines do occur. We're experiencing one right now. We emphasize having short-term income needs set aside in more stable investments. One of the last things we want to be forced to do is sell stocks in a down market. Using a bucket-based approach and diversifying across time periods tied to how you are living your financial life helps accomplish this. As I mentioned, markets will always go through cycles, and planning ahead can help prepare for when the escalator resumes climbing.